If you pay attention to the financial media at all, you've probably seen the word alternatives coming up more and more regularly. This week, we're going to discuss exactly why that is and really what is the importance of alternatives. So this week's commentary is on the importance of alternatives. We're going to talk about what they are, what opportunity exists, and what important costs and considerations need to be understood before people might considering adding alternatives into their portfolio. First of all, what is an alternative? You ask 10 different people in the industry, you're probably going to get 10 pretty different answers. As Investopedia describes it, it's a financial asset that doesn't fall into a conventional investment strategy. That probably makes some sense. For us here at 10 Capital, we think about them largely, again, along those same lines, but just something that typically wouldn't be in one's portfolio and that should act differently more times than not than just the traditional stocks and bonds that comprise most traditional portfolios. Examples of what an alternative can be from everything from just a mutual fund market neutral strategy all the way up to private equity and private credit with 5 to 7 year lockups and a whole lot in between. The idea is just to lessen correlations, which is just a fancy word for saying, again, get something in there that acts differently than the other things to help improve risk-adjusted returns. So what is the opportunity and where does that opportunity come from? Well, most people can rattle off a lot of the S&P 500 companies. These are the household names that we know and use on a day-to-day basis. However, what would surprise a lot of people is if you looked at companies with over $100 million in revenue, no, not one of the biggest companies in the world, but big companies in America, 87% of companies that fit with 100 million or more in revenue are private. Half the debt that's outstanding on the corporate side, again, falls within companies that are not publicly traded. Point being, one of the things we talk about regularly here at 10 Capital is, hey, look, we want as many options on the table as we can get. We want to have flexibility amongst those options. And so if you want to have a number of options on the table and you've got 87% of your opportunity set in private markets, it would behoove many investors to consider how they might be able to access those opportunities. Second is what alternatives, again, broadly speaking, can do to a portfolio. Matt will pop up on the screen here, a piece from JP Morgan. It's also in the written commentary if you want to be able to access it that way. That just shows the addition of alternatives, looking back over the last 35 years or so. In whatever mix of stocks and bonds one might already have, adding in alternatives is a great way to not only potentially improve returns, but also mitigate volatility. Again, through that lessening of correlations, other way of putting it, improving one's diversification. This whole idea was summarized recently by Hightower's head of alternatives, Robert Picard, in an article that, again, we've included in this week's written commentary if you want to look at it, where he said, "We know that portfolios with large allocations to alternative assets tend to deliver better risk-adjusted returns. Clients have been rewarded with higher risk-adjusted returns in exchange for taking on illiquidity," which brings us now into costs and considerations. As we talked about a few weeks back, more around the volatility concept, there's always a price of admission. Again, don't think of it as a fine, but there's a cost to everything. If you want to have gains, a good time at the amusement park, whatever the case may be, there's that price of admission. The price to access alternatives most of the time is giving up some liquidity. If we think about that LIV methodology, we've got the liquidity arm, income, volatility, expected return. If you're willing to give a little bit on that L, that's how, from a volatility and expected return standpoint, you can better things as that JP Morgan chart highlighted. These can range, some cases can be daily liquid type things where there's not a whole lot of liquidity. As you get more into that private sphere, it can be everything from quarterly liquidity up to things that could be locked up for 7 to 10 years. So again, understanding how to address the liquidity you may need, how you're going to address the capital calls or the requests for capital that these private investments may have is all part of not only identifying what might be a great investment, but really, again, how are you going to construct the whole portfolio to be able to support and take advantage of the opportunity set that those investments can bring. Another important cost and consideration is as soon as something gets hot, as soon as to the very first point of this video, people start talking about it regularly. Private credit has become a hot spot in the market. There are lots of new vehicles to even access private equity for clients. Gets popular. Lots of players enter into the space. People want to try to chase those assets. As we've gone through things, lots of people coming into the space, very few people who do it well. So in addition to identifying what you might want to have just as an asset class, how you can actually fit it within your portfolio comes the consideration of who can actually deliver the types of results and returns that I want to be able to see in that portfolio, who's really got a track record of being able to, more times than not, again, do a great job of managing that asset. These are all different components, costs, considerations that, again, the team here at 10 Capital is happy to walk you through in what would undoubtedly be a very custom, bespoke portfolio to your specific needs. There are things that, again, can be very simple, but can still do a lot to help clients diversify their portfolios outside of those traditional asset classes. It's something that's been a big part of our approach for a number of years here now. The idea is really understand the full opportunity set out there and take full advantage of it. To close out, it's an opportunity that shouldn't be ignored. It's not one without some costs and some important considerations and structurings that need to be addressed, but it likely, for most investors, can play an important role in helping you reach your goals. If you got any questions, we're always here to chat. Thanks so much.